You have probably walked into a bank, made a deposit, and never given it a second thought. The teller smiles, you get your receipt, you leave. What you did not know, what nobody told you, is that depending on the amount of cash you handed over, a federal report may have been filed on you before you reached your car. Not because you did anything wrong, not because anyone suspected you of anything, simply because the amount crossed a number written into federal law over 50 years ago. And here is the part that surprises people the most. The report goes to a federal agency whether the money is dirty or clean, whether you have been banking at the same branch for 30 years, and whether the teller knows you by name. This video is going to change how you think about cash. Not to frighten you, to protect you. Because the danger in this rule is not the rule itself. The danger is in what people do when they find out about it and try to handle it on their own, without knowing the full picture. The legal foundation here is the Bank Secrecy Act of 1970. Congress passed it to give the federal government a way to track large cash movements that might be connected to criminal activity, drug trafficking, organized crime, money laundering. The mechanism it created is called the Currency Transaction Report, or CTR. Here is what the CTR requires. Anytime a customer conducts a cash transaction, a deposit, a withdrawal, an exchange of more than $10,000, the bank is required by law to file a report with the Financial Crimes Enforcement Network, a bureau of the United States Treasury known as FinCEN. The bank does not ask your permission. The bank does not give you a heads up. There is no opt-out. Filing the CTR is mandatory, and the bank can face its own penalties for failing to do so. The CTR captures basic information: your name, your address, your identification, the date, the amount, and the type of transaction. That information is then stored in a federal database, where it can be accessed by law enforcement agencies including the IRS, the FBI, and the DEA. First, a CTR is paperwork, not an accusation. FinCEN receives roughly 19 million CTRs per year. The overwhelming majority involve completely ordinary people doing completely ordinary things. A retiree withdrawing cash to buy a used boat. A small business owner depositing a week's worth of register receipts. A family moving money after selling a house. Being the subject of a CTR does not mean you are under investigation. It means you moved more than $10,000 in cash. Second, cash has a specific legal meaning here. Physical currency, bills and coins. A check for $50,000 does not trigger a CTR. A wire transfer for $200,000 does not trigger a CTR. Only the movement of physical currency counts for purposes of this reporting requirement. This distinction matters, and we will come back to it. Third, the $10,000 threshold applies per transaction, but the definition of transaction is broader than you might expect. A bank is required to aggregate multiple cash transactions made by the same person on the same day if the total exceeds $10,000. So two deposits of $6,000 each, made the same morning at the same branch, can be treated as a single transaction for CTR purposes. Understanding this is essential, and it leads directly into the most serious legal danger in this entire topic. Before moving to that danger, there is a second type of report that deserves its own explanation, because it catches people off guard in a completely different way. The Suspicious Activity Report. The SAR operates by different rules entirely. There is no dollar threshold. A bank can file a SAR for a transaction of $50 if the circumstances seem off. A SAR can be triggered by the way you behave at the teller window, by a transaction that breaks from your usual pattern, by something you say, or by something the teller notices and cannot easily explain. Here is what makes the SAR particularly significant. You will never be told one was filed on you. The bank is legally prohibited from disclosing it. The term used in the law is tipping off, Singholler, and banks can face criminal liability for letting a customer know a SAR has been submitted. From your side of the transaction, everything looks normal. The receipt prints. The bank teller smiles and thanks you for your business, and a federal report goes into the system without your knowledge. SARs are reviewed by FinCEN analysts. If a pattern develops across multiple reports, or if the information connects to an existing investigation, the matter can be referred to law enforcement. And unlike the CTR, which is a routine filing, a SAR is specifically designed to flag behavior that appears designed to conceal or evade. The CTR and the SAR are the infrastructure. They are the system banks use to report cash activity to the federal government. Taken on their own, they are something to understand, not something to fear. The fear, the part with real criminal consequences attached to it, comes from what happens when someone finds out about the $10,000 rule and decides to be clever about it. The word you absolutely must know is structuring. This is a critical rule. It refers to the practice of deliberately breaking up cash transactions, keeping each one below $10,000, specifically to avoid triggering a currency transaction report. And under federal law, it is a crime, not a fine, not a warning, a felony. The statute is 31 United States Code, Section 5324. It makes it illegal for any person to break up a transaction, cause a transaction to be broken up, or assist someone else in breaking up a transaction for the purpose of evading the CTR reporting requirement. The penalty can include up to 5 years in federal prison. If the structuring is connected to other illegal activity, that rises to 10 years. None of that is the part that stops people cold. This is the part that stops people cold. You can be convicted of structuring even if every dollar you deposited is completely legitimate. Even if you paid taxes on it. Even if you earned it legally, saved it honestly, and have documentation for all of it. The law does not require the money to be dirty. It requires only that your behavior was designed to avoid the report. The United States Supreme Court addressed this directly in Ratzlaff v. United States in 1994, and Congress has since refined the statute to make the intent standard explicit. The government does not need to prove you were hiding criminal proceeds. It needs to prove you knew about the reporting requirement and deliberately structured your transactions to avoid it. The instinct to push back on this is natural. If the money is yours, if it is clean, if you have nothing to hide, how can the act of depositing it in stages be a federal crime? The legal reasoning works like this. Congress determined that the act of deliberately avoiding a reporting requirement is itself suspicious, regardless of the source of the funds. The behavior signals concealment. And concealment, not the money itself, is what the law targets. In the government's view, someone with nothing to hide has no reason to structure. Someone who structures is, by definition, trying to prevent the government from seeing something. That reasoning is deeply frustrating. It has also been used to seize assets from people who were not charged with any underlying crime. Farmers, small business owners, restaurant operators, people whose only offense was depositing their own cash in amounts they thought were safer. Civil asset forfeiture cases built on structuring have drawn significant criticism from legal scholars and members of Congress on both sides of the aisle. But even so, the law remains. And for retirees handling large cash transactions without legal guidance, it remains a live danger. These are not hypotheticals constructed to illustrate a legal point. These are the specific situations that send ordinary law-abiding retirees into contact with federal banking law, usually without knowing it until much later. Scenario 1. Selling a car for cash. You have a second vehicle you no longer need. A private buyer offers you $14,000 in cash. You agree. The sale is legal. The money is yours. You drive home with an envelope of bills and you think about depositing it, but something makes you hesitate. You have heard something about the $10,000 rule, not the details, just the number, and you do not want to cause a problem. So you deposit $9,500 on a Tuesday and $4,500 the following week. That decision, made out of vague caution, not criminal intent, is structuring. The transaction was split deliberately, below the threshold to avoid a report. The source of the money is irrelevant to the charge. Scenario 2. A gift from your children. Your adult children want to do something meaningful for your retirement. They pull together $18,000 in cash from their savings, from a bonus, from money they set aside over the course of a year, and they give it to you. Maybe they hand it over in 2 visits, thinking it will feel less overwhelming. Maybe you receive it all at once but decide to deposit it in pieces because you are not sure how the bank will react. Either way, if the deposits are structured to stay below $10,000, the federal standard for structuring applies to you and potentially to them. Scenario 3. Moving savings between banks. You have kept your money at the same institution for 20 years, but you have decided to move to a credit union with better rates. You have $25,000 in a savings account. You withdraw it in cash because that is how you have always handled money, because it feels more concrete, because you want to hold it yourself during the transition. But you are nervous about the report. So you do 3 withdrawals across 10 days. $9,000, $9,000, $7,000. Structuring does not apply only to deposits. It applies to withdrawals as well. What you just described is a structured withdrawal, and it carries the same federal exposure. Scenario 4. An inheritance in cash. Your mother passed away. She was 83 years old. She did not trust banks the way her generation often did not trust banks. And she kept her savings, $30,000 in cash, in her home. You inherit it. It is completely legitimate. You have the will, the death certificate, and a clear line of succession. But you are not sure how to handle walking into a bank with $30,000 in cash. So you spread the deposits out over 6 weeks, keeping each one just under $10,000. The source of the money is clean. The documentation exists. None of that changes the legal character of what you did. The deposits were structured, and the law applies. Scenario 5. A Social Security lump sum. The Social Security Administration determines that you were underpaid for a period of time, 2 years, 3 years, and issues you a retroactive lump sum payment. Depending on your benefit level and the length of the underpayment, this can amount to $20,000 or more. The SSA issues this as a check. You cash it at your bank. You keep some of it as physical cash for immediate expenses, and deposit the rest over the following weeks. This scenario does not necessarily trigger a structuring charge, because the initial transaction was a check, not cash. But the subsequent handling of the physical currency, depending on the amounts and the pattern, can trigger a suspicious activity report. A teller who sees you making repeated cash deposits in amounts that cluster just below $10,000, even without any intent on your part, may be required to file one. And a SAR has no dollar threshold and no intent requirement on the bank's side. This is the single most actionable instruction in this video, and it needs to be stated plainly. Never say, not as a question, not as a joke, not as an explanation, not in passing, the words, "I want to keep it under $10,000. The moment those words leave your mouth, you have told the teller that you are aware of the reporting threshold and that your intent is to avoid triggering it. That is the legal definition of structuring, spoken aloud in a federally regulated institution. To a person who is trained to recognize it and required by law to act on it, the teller will file a suspicious activity report. They may be required to flag the account. And unlike almost everything else in this video, that outcome is entirely within your control because it depends entirely on what you say. If a teller asks why you are making the deposit the way you are making it, the correct answer is a calm, honest explanation of where the money came from. Nothing more. Nothing dramatic. The source of the money is your protection. Use it. Everything covered so far, the CTR, the SAR, structuring, the 5 scenarios, the teller warning is information. It is not a verdict on anything you have done. It is the context you needed before you could make good decisions. The good decisions are straightforward. They are not complicated. They do not require an attorney or a financial advisor or a course on federal banking law. They require a folder, a habit, and about 10 minutes the first time you sit down to set it up. Transparency is not a vulnerability. It is the only protection that actually works. This is the shift in thinking that separates the people who walk through large cash transactions without incident from the people who end up in a situation they cannot easily explain. The CTR is not the enemy. The SAR is not the enemy. A federal report filed on a clean transaction with a clear paper trail behind it leads nowhere. It gets logged, it sits in a database, and nothing follows from it because nothing needs to. The report is paperwork. Clean paperwork with a clean explanation attached to it is not a problem. It is a record. The only problem worth worrying about is behavior that looks like concealment. And the simplest way to ensure your behavior never looks like concealment is to never behave like someone who is trying to conceal something. That means depositing cash in full when you have it. That means being straightforward at the teller window. And it means keeping a small amount of documentation that tells the story of where your money came from, in plain language, before anyone ever asks. The documentation habit is not about building a legal defense. It is about having an answer ready, a clear, calm, factual answer. So that if a question ever arises, you are not scrambling to reconstruct something from memory 2 years after the fact. Document 1. A bill of sale for any private cash transaction. Anytime you sell something of significant value for cash, a vehicle, a boat, a piece of equipment, jewelry, furniture, anything where the amount exceeds $2,000, write up a simple bill of sale. It does not need to be drafted by an attorney. It needs to contain 5 things: the date of the transaction, a description of the item sold, the sale price in full, the buyer's name and contact information, and both signatures. Keep a copy for yourself. If you can, photograph or scan it the same day. This document does one thing. It establishes the origin of the cash before it ever reaches the bank. If a CTR is filed when you deposit the proceeds, and if that CTR ever draws any attention, the bill of sale answers the only question that matters: where did this money come from? Document 2. A gift letter for any cash gift received. If someone gives you a meaningful amount of cash, a child, a sibling, a close friend, ask them to write a brief gift letter. It can be handwritten. It needs to say the giver's full name, their relationship to you, the amount given, the date, and a single sentence confirming that the transfer is a gift with no expectation of repayment. The giver signs it, you keep it. The gift letter matters for two reasons. First, it documents the source of the funds. Second, it distinguishes the transaction from a loan, which can carry its own tax implications. A one-page letter, written in 10 minutes, handles both concerns at once. Document 3. Estate documentation for inherited cash. If you receive cash as part of an inheritance, whether from a formal estate or from a family member who simply kept money at home, gather the documentation that connects you to it. A copy of the will or the relevant section of it. The death certificate. A letter from the executor, if one exists, confirming the distribution. If no formal executor was involved, a signed, dated letter from other family members who can attest to the circumstances is better than nothing. Keep these documents together, in one place, labeled clearly. If you deposit the inherited cash in full on a single visit, tell the teller plainly what it is. This is cash from an estate I inherited. 4 words of explanation, delivered without hesitation, carry more weight than any amount of paperwork, because they signal that you are not hiding anything. Document 4, a personal record for anything that feels unusual. This is the simplest document of all, and the one that requires the least effort. Keep a small notebook or a document on your computer or a note on your phone, whatever format you will actually use, and write a 1-paragraph entry anytime you conduct a cash transaction that strikes you as out of the ordinary. The date, the amount, the source, the reason. 3 sentences is enough. You are not filing this anywhere. You are not sending it to anyone. You are simply creating a contemporaneous record, meaning a record made at the time, that documents your state of mind and your understanding of the transaction at the moment it occurred. If a question ever arises months or years later, that record is worth considerably more than a memory. The conversation at the teller window does not need to be complicated. It does not need to be lengthy. What it needs to be is calm and honest. If you are depositing a large amount of cash and the teller asks where it came from, answer the question directly. I sold my truck. My daughter gave this to me as a retirement gift. This is part of an inheritance. You are not required to go further than that. You are not required to produce documentation on the spot, though having it with you is never a bad idea. You are simply required to tell the truth, briefly and without visible anxiety. Anxiety, in a banking context, can itself attract attention. A person who is flustered, who gives a vague or shifting explanation, who seems reluctant to answer a routine question, that is the behavior that gets noted. Not because the teller is suspicious of you personally, but because that pattern of behavior is one of the things they are trained to observe. The version of you that the bank should see is the version that has nothing to explain, because you have already explained it to yourself in writing before you walked through the door. If you make a large legitimate cash deposit and the bank files a currency transaction report, the practical experience from your side is this. Nothing happens. You get your receipt. You go home. No letter arrives. No agent calls. No audit is triggered. The CTR goes to FinCEN. It is processed, logged, and stored. Analysts at FinCEN do review CTR data, but they are looking for patterns, repeated filings, connections to known investigations, transactions that align with other suspicious activity in the database. A single CTR on a retiree who deposited $14,000 in cash from a car sale with a clean banking history and no other flags in the system is not going to draw a meaningful response. The only circumstances under which a CTR becomes the beginning of something larger are the circumstances where other factors are already present: a prior suspicious activity report, a connection to a name in an existing investigation, or a pattern of transactions across multiple filings that, taken together, suggest deliberate evasion. For someone who banks honestly, deposits in full, and keeps reasonable records, none of those circumstances apply. The CTR is not the danger. The danger was always the attempt to avoid it. 4 things. That is what this comes down to. 1. Any cash transaction above $10,000 triggers an automatic federal report, the currency transaction report. The bank files it without your knowledge and without your consent. It is not an accusation, it is a record, but it is a permanent one, stored in a federal database, accessible to law enforcement agencies including the IRS, the FBI, and the DEA. It exists whether the money is clean or not, whether you have banked at the same branch for decades or walked in for the first time. 2. The suspicious activity report operates on entirely different terms. No dollar threshold. No minimum amount. No requirement that the transaction itself be unusual. Only that something about the behavior surrounding it raises a flag. And you will never be told one was filed. The bank is legally prohibited from informing you. The SAR moves through the system invisibly. And the only thing that determines whether it leads anywhere is what the analysts on the other end find when they look at the broader picture of your account. 3. Structuring. The act of deliberately breaking up cash transaction to stay below $10,000 is a federal felony under 31 United States Code, Section 5324. It does not matter if the money is legitimate. It does not matter if you paid taxes on every dollar. It does not matter if the intent was simply to avoid paperwork, rather than to conceal a crime. The law requires only that you knew the threshold existed and that you deliberately arranged your transactions to stay beneath it. 5 years in federal prison is the standard maximum. 10 years if the structuring is tied to other criminal activity. And civil asset forfeiture, the seizure of the funds themselves, without a criminal conviction, has been used in structuring cases against people who were never charged with anything else. 4. The documentation habit takes 10 minutes to set up and eliminates virtually all of your exposure. A bill of sale for private cash sales, a gift letter for cash received from family, estate documents for inherited funds, a personal written record for anything that feels out of the ordinary. These 4 documents, kept in a single folder, tell the story of your money before anyone asks. And a story told clearly, in advance, by someone who has nothing to hide, is the most effective legal protection available to an ordinary person who is not a criminal and does not need to be treated like one. This video exists because the information in it is not difficult. The concepts are not beyond anyone who has managed their own finances for 30 or 40 years. The law is written in plain enough terms that a careful reading of the statute answers the most important questions directly. And yet the people who need this information the most are precisely the people least likely to encounter it in a form that is honest, clear, and free of alarm. Financial content aimed at retirees tends toward one of 2 failures. It either buries the real risk under so much reassurance that the warning disappears, or it weaponizes the fear to keep people watching without ever giving them something they can actually use. Neither of those serves you. What serves you is knowing that the $10,000 rule is real, that structuring is a felony, that the SR exists and operates in silence, and that the answer to all of it is not to be afraid of your own money. It is to be organized about it, to deposit honestly, to document clearly, to speak plainly at the teller window, to keep a folder with 4 types of documents in it and update it whenever something significant happens. If you have already done something described in this video, if you recognize yourself in one of the 5 scenarios, take a breath. The overwhelming likelihood is that nothing has happened and nothing will. The purpose of naming those scenarios is not to make you feel like a suspect. The purpose of naming those scenarios is not to make you feel like a suspect. It is to make sure you do not repeat the pattern now that you understand why it matters. Go back to honest, straightforward banking. Build the documentation habit starting today. And if you have a specific situation that genuinely concerns you, an inheritance, a large private sale, a cash gift of significant size, consider a single consultation with a financial attorney before you make the deposit. 1 hour of professional guidance, applied at the right moment, is worth considerably more than any amount of worry applied after the fact. Someone you know, a spouse, a sibling, a friend who is a few years from retirement, has probably never heard the word structuring in a banking context. They may have done exactly what the 5 scenarios describe, not out of any intent to deceive, but out of the same vague instinct that leads most people to handle large cash amounts carefully. A sense that the bank is watching, that a big deposit will cause a problem, that it is safer to be quiet about it. That instinct, applied without the knowledge in this video, is the instinct that turns a clean transaction into a federal matter. Send this to them, not as a warning, not as something alarming. Send it the way you would send anything that made you think, I wish someone had told me this sooner. Because the information is straightforward, the protection it offers is real, and the cost of not knowing it at the wrong moment is genuinely significant. The $10,000 rule was not written to trap honest people. It was written to track criminal money. The problem was never the law itself. It was the gap between what the law says and what ordinary people know about it. That gap is closed now.